Welcome to the Lane Gorman Trubit COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. Congratulations! You got your PPP loan funded. This webinar will tell you how to use that money in the first 8 weeks in order to qualify for loan forgiveness, and how to properly record and track the financial information. It was recorded live as a Zoom webinar on April 16, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
All right, it is 3 o'clock. I know folks are still signing in, but let's go ahead and get started, make sure we're respectful for everyone's time. Thank you for joining us today. My name is Lucas Lachance. I'm a partner here at Lane Gorman Trubit, responsible for business development and community outreach. I'm looking down the list of attendees today, and I'm very happy to see a number of friends of the firm are joining us. But we've also got some new folks, and so I want to take a minute or two and tell you a little bit about LGT. LGT is a full-service public accounting firm. As you can imagine, we handle anything tax-related. That's why we're here today. But in addition to that, we also offer assurance services like compilations, reviews, and audits. We have our accounting and consulting group that does project-based work. A lot of that would be monthly bookkeeping services, for example, or CFO by the hour. And we have our financial advisory group that handles long-term financial planning, as well as asset management. If you haven't had a chance to do so already, please check out our COVID financial resource page on our website. There is a link that will be sent out during the broadcast in the chat, and the web address is up there for you as well. We'll also be sending out a survey following the conclusion of the webinar that will include a link to all the PowerPoint slides. Let me tell you a little bit about how this is going to go today. We have 2 presenters for us on the panel, and we also have a team of folks working behind the scenes answering questions. So as the presentation goes along, if there's something that you want to know a little bit more about, go ahead and send that question in through the chat function. Our folks behind the scenes will pick those up, and hopefully we'll be able to try to answer them while we're all here together. Let me also introduce you to our 2 panelists today. First up is Colin Kanellakis. Colin joined our firm in 2000 and has over 2 decades of experience in public accounting. He's the current leader of our LGT's Dealer Services Group, which is the largest niche in our firm. He spends approximately 90% of his time working with various types of dealerships by providing assurance, tax, and consulting services. He also attends and participates in several local, state, and national associations to keep current on happenings and trends within the industry. Prior to his focus in dealerships, Colin also worked with construction contractors, real estate developers, not-for-profit organizations, oil and gas exploration firms, and on employee benefit plans. Colin is joined today by Denver Todd. After joining our firm more than 8 years ago, Denver has proven to be an asset not only with our firm, but within our tax department. He focuses his knowledge and efforts within our dealer services group as well, along with their related finance companies and real estate entities. Some of his current responsibilities include providing proactive tax planning and compliance services for corporate and partnership returns. He also prepares and reviews individual, corporate, and partnership income tax returns, as well as state income and franchise tax returns. Denver's additional duties include the training and supervision of our tax staff, but he also serves as a liaison between our partners, clients, and our professional staff on tax engagements. Ladies and gentlemen, please welcome Colin Kanellakis and Denver Todd.
All right, thank you, Lucas. I'm going to give you a little bit of a background on today's presentation and how it's going to flow. I know Lucas mentioned we're going to be working through live Q&A. What we're going to try to do is focus our Q&A on most commonly asked questions that we're hearing from our clients and other contacts as we work through the PPP forgiveness component of this loan plan. We'll do that towards the end, and we'll also go over some of the most commonly common best practices as well. If we have time, we'll work our way through a few selected questions that the group has put out there, and we'll certainly like to be a resource for you. We have a good generic email address. Ask us at lgt-cpa.com. We'll show that on the last screen. We'd love for you to direct any other questions that you have, either to us or to that email address, and we'll do our best to answer your questions. So the way that this is going to flow today, Denver, if you want to get us to the, we go. We're going to talk about the key terms of the PPP, which is the Payroll Protection Program. We're going to talk about the use of funds, and starting out with how much you ultimately borrowed in the first place. We're not going to go too much into that because the plan is actually pretty tapped out right now unless additional funds are approved through Congress. So we'll talk more on the use of funds and best practices on the actual use and monitoring of those funds. Then we'll go through some examples of how the forgiveness calculation works and what some scenarios show the actual forgiveness component of the loan could be. And then we'll work through best practices for managing the funds. So this would be those of you that have already gotten your funds. What should you do with them? How should you monitor them, as an example? And then we'll finish up with some common questions, as I mentioned. Let's go back to that prior program, disclosure. So this is just as most webinars that you hear, this is just a standard disclosure. This presentation is informational in its purpose, mainly because the information that's contained is constantly being updated, new information coming out all the time. And so there could be, based upon your nuances, situations that if we knew more information, we'd give you different answers. So I'll turn it over to Denver to get started with our presentation. Thank you.
All right, thank you, Colin. As Colin mentioned, I'll be talking about the SBA loans today, specifically the PPP loan, or the Paycheck Protection Program loan. And here's a comparison of the other SBA loans that can be applied for, but I'll only be talking about the PPP loan. Before I get started into the slides, two things really as we go through this. The first thing is to understand Congress's intent. They want these loans to be used to keep people employed. So if there's any reductions in the headcount, or the reductions in employees, or substantial reductions in employee pay, that can affect the forgiveness portion of the loan. And then secondly, the loan amount, there's two calculations. The first one is when you're doing the calculation for how much you're going to get loaned. That's a completely separate calculation than when you're trying to figure out how much of the loan can be forgiven. So just keep that in mind as we go through this. And as Colin mentioned, this is through Monday is what the SBA released. I'm just going to give you a little statistics that were released on Monday from the SBA. They've actually stated on their website today that they're completely capped out on the applications. So they are no longer accepting applications at this point until more funds are appropriated to the program. So it looks like there's about 100 billion in funds, or in loans, that were approved in the last 2 days, because there's 349 billion that was allocated to this program. Secondly, here's just to show you the different sizes of loans that there have been. The average size is $240,000. And then here's by state and territories. You can see Texas is leading the way with almost 90,000 loan approvals through Monday, and leading the way in approved dollars at almost $22 billion. And then this is just to show you what different industries have been being approved and receiving loan dollars, and construction's leading the way. But this is just informative, and you'll have these slides so you can look through this at your leisure. Okay, so as Colin mentioned, we're going to assume that you were already approved for a loan. So we're going to skip the eligibility, but we'll do a little brief recap on the key terms and how the loan amount is calculated, because for the loan amount, payroll costs, that definition is used for the forgiveness as well, so it's important to understand. Key terms, so you have a 1% interest rate. It's a 2-year term for the balance that's not forgiven. There's no collateral, no personal guarantees, no prepayment penalties, and no closing costs. And the main thing that a lot of people are interested in is there's a portion or all of the loan can be forgiven. And if the portion that's not forgiven, let's say you get a $100,000 loan, but you can only get $70,000 forgiven, then the $30,000 would be the portion that's not forgiven, and there'd be a 6-month deferral, and but the interest would still accrue. And then the great thing about these loans is you don't have to seek credit elsewhere, and there's no creditworthiness assessment because SBA is backing the loan 100%. Okay, let's talk a little bit about how the loan is calculated, the loan amount. And for a lot of you, you have already got past this point because you have the loan now and it's probably being deposited, or it should be soon. But let's just recap real quick. So the loan amount in general, it's going to be the lesser of 2.5 times the borrower's average monthly payroll cost, or $10 million. You're probably wondering, okay, what's the time period for the average monthly payroll costs? The statute said the prior 12 months from when the loan was, when you applied for the loan. So if you apply in February of 2020, the prior 12 months would be, if you apply in April of 2020, the prior 12 months would be April 1st, 2019 through March 31st, 2020. But on the application, then further guidance from the SBA, it says you can use the 2019 for your average payroll costs, and you can actually choose between either or ultimately it's your lender that you have to discuss with, and it's whatever they're comfortable with, because they're going to approve the loan and then they're also going to be approving the forgiveness. And then at the bottom, if you weren't in business all of 19 or in that period of 19, there's a way you calculate it there. Okay, so as I mentioned, it's average monthly payroll costs. So let's discuss a little bit about what payroll costs are. So it's obviously your wage, commission, salary, and then you have paid sick leave, severance, then you have your group health benefits, retirement benefits, state and local employment taxes, like if you're paying to the Texas Workforce Commission. And then this is something that came out on Tuesday. Partnerships can include self-employment income of general active partners up to $100,000 annualized. And I'll talk more about that on the next slide. Okay, so more about what the guidance said on Tuesday that came out. And this was in reference to a partner that's in a partnership. You may not submit a separate PPP loan application for yourself as a self-employed individual. This is talking about a partner in a partnership. Instead, the self-employment income of general active partners may be reported as payroll costs up to $100,000 annualized on a PPP loan application. So if you have a partnership that you've already applied and you got your proceeds, it's unlikely that you can go back and get more money. But this is good going forward when you're applying for forgiveness. This can count. And we'll talk more about the 100,000 annualized. And if you want to read more about it, there's a link at the bottom that you can click on to go to it. And in this guidance as well, the guidance was mainly for Schedule C filers, which would be usually a sole proprietor or a self-employed individual. And this area is beyond the scope of this presentation. So if you are a Schedule C filer, then speak with your CPA and direct them to that guidance that's in the link on the spreadsheet, in the PowerPoint, and they'll be able to find more information. Okay, so what is excluded from payroll costs? What do you not count? In the definition, or in the guidance that came out, it says cash compensation for individual employees in excess of an annual rate of $100,000. And that would mean if you paid someone $100,000, you get to count the first $100,000, then anything in excess of the $100,000 you not get to count. But when you're capping it at $100,000, that does not apply to retirement, health benefits, or state local taxes. So those can be added on to if someone made 150,000, they'd stop at 100, then you get to add the retirement health benefits and state and local taxes on for employment that you pay towards employment. For the forgiveness calculation though, because the forgiveness calculation uses the same definition of payroll costs, the cash compensation, when it talks about the 100,000, that's annualized over the 8-week period. And in the guidance that was released on Tuesday, this was specifically geared towards self-employed individuals, but they took 8 weeks divided by 52 and multiplied it by 100,000 to come out to $15,385 per employee. And we got to wait for more guidance, but it looks like each employee, when you're paying someone in the 8-week period that I'm going to talk about in a few slides, it looks like you're capped to $15,385 per employee, because a lot of people are asking questions. Can I go and pay someone $50,000 or $30,000, some really large bonus or whatnot in the 8-week period to get my payroll costs up? Well, they're going to be capped, and I think it's going to be the $15,385 per employee. And then you get to include the retirement health benefits on top of that. Okay, so also not counted toward payroll costs is your payroll taxes, the employer side. The employee side is counted towards because it's part of gross payroll, so that will be counted, but the employer side of FICA is not counted. And then also what's not counted is your qualified sick leave and family emergency leave wages. This would be if you have any employees that have COVID-19 or they have to take off work for COVID-19 because a family member to watch the kids, and you're paying those type of wages that give you the credit on your payroll tax form. You cannot include those wages as payroll cost in the loan amount or the forgiveness amount. Okay, so let's go through example real quick, and then we'll get into the forgiveness portion. Okay, so this is a company, and they had on average $100,000 of average monthly payroll over the 2019 or the prior 12 months. What you do is you multiply the 100,000 by 2.5, you come up with 250,000. That'd be your maximum loan amount, because remember, it's the lesser of 250,000 or 10 million. Okay, so what can the funds be used for? The acceptable uses of the funds, you can use them for payroll costs, you can use them for mortgage interest payments, you can use it for rent, utilities, and then also you can use it on interest on any other debt obligations that were incurred before February 15th, 2020. On this last one, when you go to what costs count towards forgiveness, they only list the first 4 costs. They don't list the 5th one about interest on any other debt obligations. So it looks like you can pay interest on debt obligations that were incurred before February 15th with the proceeds, but it wouldn't count towards eligible expenses for forgiveness. Okay, so what happens if you use the funds for something other than the expenses that I just listed on the prior slide? Well, obviously you're going to have to repay those funds because they're not going to qualify for forgiveness. And then secondly, the SBA can, they're stating they could go take further action against you. So just keep that in mind. Okay, so now to the forgiveness portion. So how much of the loan will be forgiven? So how this works is there's an 8-week period that starts on the date that you receive the first disbursement of loan PPP loan funds. When you get that first disbursement of PPP loan funds, it starts an 8-week period that you're going to want to keep track of these expenses that I discussed in a minute, because they're going to go into your forgiveness calculation to figure out how much of the loan can be forgiven. So what payments are covered? So as I was mentioning earlier on the slides, you get to count payroll costs, you get to count interest on a mortgage incurred before February 15th, which would be on real or personal property. You get to count rent for a lease that was enforced before February 15th, 2020. And I know there's a lot of questions. There's nothing about renting to a related party in there where it's barring you from doing that. So there's nothing out there right now. And lastly, any utilities for which service started before February 15th, 2020. And there's a description of the different types of utilities that would qualify. And then, as I mentioned on the slides before, that part about using the funds for interest on any other debt obligations, it's not included in this section. So for now, we got to go with these 4 items unless something else is issued that says otherwise. And then most importantly, the non-payroll cost items, which would be the interest, rent, or utilities, it's limited to 25% of the amount that's being forgiven. And you'll see in a second how this works. Okay, more about the 8-week period. As I mentioned, it begins when you first receive the funds in your bank account. And this question's come up a lot. Can I get approved for the loan, but then wait until, let's say, late April or late May, June, or even July? How long can I wait before I can start the 8-week period? Can I prevent the bank from depositing the funds right after I'm approved? And based on what's been released, the answer is no. The lender must make the first loan disbursement no later than 10 calendar days from the date of loan approval. So there were some people that were asking about potentially pushing off the disbursement of the funds till later on the year because they felt the economy would be better and the payroll costs would be higher in that period. So then they'd have more costs that would qualify for forgiveness. But it doesn't look like you can do that. And then in the 8-week period, the expenses must be incurred and paid within the 8-week period. Right now, based on how it's written, it doesn't look like accrued expenses will count. Expect further guidance on this, but it seems that it's going to be completely on the cash basis. Whatever's paid within that 8-week period counts towards your eligible expenses that will go into the calculation. Okay. So here is a calculation of the eligible expenses, and then we're going to see how it all works. So let's just say your 8-week period started, you got your funds, and over the next 8 weeks, you pay the following expenses. You pay $180,000 for payroll costs, and then for non-payroll costs, you pay $71,000. For your non-payroll costs, you're actually limited where you can only count $60,000 because how it works is you have to back in to what the maximum of your loan forgiveness is, and it's really if you take the $180,000 divided by 0.75, you get $240,000. Because on the previous slide, the SBA's come out and said when you go to your lender and show them, here's all my expenses for forgiveness, and you only have $180,000. Well, what the guidance says is you can only have 25% of non-payroll costs that can be forgiven. So just mathematically, if your payroll costs are $180,000, then you can only have $60,000 of non-payroll costs that would count towards being eligible expenses to be forgiven. So that's where you get the $60,000. So if you add the $180,000 and the $60,000, that's where you get the $240,000 for your potential loan that can be forgiven. And then as you, on the previous slides that we went over, the loan amount was $250,000. So we got a loan of $250,000. We spent our funds over the period, or the majority of them, but only $240,000 of the money we spent qualifies for as potential loan forgiveness. So $250,000 minus the $240,000, you're going to have to repay $10,000 at this point. But what we have to see is any of the $240,000 going to be reduced? Because there's two potential ways that your potential loan amount can be forgiven. And then there's a comment right there. It looks like you're going to be capped at $15,385 per employee over the 8-week period. Okay, so as I mentioned, the amount of loan that's forgiven, it will be reduced if you cut employees during the 8-week period, if you fire, lay off, or if you cut salary of employees during the 8-week period. And not all employees are evaluated in this test, and we'll see as we go through the examples. Okay, so the first reduction that we're going to talk about is the reduction to your headcount or employees. So in the act, what it says is you're going to take your average number of full-time employees per month employed during the 8-week period following the loan date, and you're going to divide it. You have the election. You're going to win and choose the lesser of, because you'll see how the calculation works in a second. You're going to look back to February 15th, 2019 through June 30th, 2019, or you're going to look to the first 2 months in 2020. And each of those two categories, you're going to have to count what your average full-time equivalents are for that period. And I know there's a lot of questions out there. What is the definition of full-time equivalent employee? We're going to have to wait to see what the SBA comes out and defines that. They haven't said anything yet. There are people that have said they think it includes part-time employees as well, but there's nothing out there that says that yet. So we'll just have to wait to see. And I know, unfortunately, you're probably thinking, well, we already have the loan. Why do we not have this information yet to be able to calculate this? Because we're trying to project out in the future. Unfortunately, it is what it is right now. They're still working on guidance for how much of a loan you can get, and the SBA hasn't started doing guidance on how to do the forgiveness calculation or how to do all these calculations, give examples or whatnot. So we just have to work with what we have for now. Okay, so let's do an example. So you have business A that has 10 full-time employees during the 8-week period after it borrows the $250,000. So during period February 15th to June 30th, 2019, it had 16 employees, just as it did from January 1st, 2020 through February 29th. Those two periods are the either or. You will choose the lesser of because it's going to give you the greater benefit. Well, it's 16 for both of them. So 16 is going to be the denominator. So how it's going to work is you're going to look at how many employees did you lose in the 8-week period compared to looking back at those two prior periods. And you lost 6 employees. So that's where you get the 6 divided by 16, or 37.5%. So you would have to reduce the $240,000 by $90,000, because essentially you've lost 37.5% of your employees over the 8-week period when you compare it back to the lesser of the two periods that you're supposed to measure against. Okay, then there's a second one. So the one I talked about a second ago was the reduction for headcount. Now this is the reduction if you reduce your employees' pay over the 8-week period. So how this works, it says the amount of an employee's reduction in total salary or wages in excess of 25% compared to the most recent full quarter prior to the date of loan. So usually how this is going to work is most people just got their loan in April, because from the SBA, it looks like you cannot get a loan any longer at this time. So everyone has their loans now. Maybe they don't have their funds yet, but they'll be getting them soon. The most recent full quarter is probably going to be Q1 of 2020. So you're going to compare the wages that were paid out in the 8-week period from when you get the loan. You're going to compare that by employee to what that employee made in the first quarter of 2020 and see if there's been a reduction of 25% or more. And we'll go through how that calculation works. One thing that there's been confusion about is above, when you're doing the valuation, if there's been a reduction in someone's pay by 25% or more, you don't have to look at every single employee. How the law was written is if you have any employees that had an annual rate of salary or wages greater than $100,000 for any single pay period during 2019, you do not have to count them or evaluate them when you're seeing if their pay has been reduced in the 8-week period versus the first quarter of 2020. So for example, if you had 24 pay periods in 2019, that means that person, I'm not going to assume commission or anything right now. Let's just assume standard salary, and I have an example about this in a second. If someone got a bonus in addition to their semi-monthly salary of $4,166, if they got a bonus in addition to that, that would push them over the $100,000 annually for just that one pay period. So then when you're evaluating to see if over that 8-week period, if that employee's wages were cut by 25% or more, you wouldn't even have to evaluate the employee. If you cut that employee's pay by 50 or 80% or whatever the number is, it doesn't matter because you get to exclude those employees when you're doing the test to see if their pay has been reduced. So let's do an example. So how this is going to work is you're first going to have to determine which employees you can exclude from the calculation. So you'd have to go back to 2019, look at what people were paid, look at the pay periods, and look per pay period and see who made over $100,000 annualized for any one pay period. So in this one, we have 3 employees, Lane, Gorman, and Trubitt. Mr. Trubitt unfortunately made too much money in 2019. So when we're determining in step 2 if we need to see if his pay has been reduced by 25% or more, we don't have to worry about him because he's an excluded employee for this test. And we could actually reduce his salary down to 0% for the 8-week period, and we wouldn't be that wouldn't factor into the calculation. I will note one thing: if you did employ anyone in 2020 where they weren't employed in 2019, you will have to look to see if their pay has been reduced by more than 25%. And the same thing for any employees that made under 100,000 annualized for any pay period in 2019. You're mainly going to be looking at them. Okay, so now we know there's only 2 employees that we have to look at, Lane and Gorman. So Lane and Gorman right here, you can see their compensation during the most recent full quarter prior to the 8-week period. You can see how much they made, and then you can see how much their compensation they're paid during the 8-week period. If you look at Lane, he had a reduction of 60% in his pay, whereas Gorman only had a 20% reduction. So since Gorman's was not in excess of 25%, we have no reduction related to him. But for Lane, the excess reduction over the 25% is 35%. So if you multiply 35% times his compensation that he made in the 8-week period, or in the most recent quarter. So if you take 35% times $8,750, that's where you get the $3,062.50. That would be your reduction. You'll see in a second how this all works, but let's go to, oh yeah, one thing. So if you look at the comparison, the most recent quarter, depending on how you look at it, it's going to be either 12 or 13 weeks versus you're comparing it to an 8-week period. That makes no sense. And this is where we need more guidance, because if you go to the next slide, and if we were to take that 13-week first quarter and average it out to over 8 weeks, Lane would actually, when you're comparing it to the 8-week period, Lane actually did not have a more than 25% reduction. So then you wouldn't be penalized for him. This is just our assumption of how it would work. So we need more guidance to know for sure this is how it's going to work, but this makes the most sense to us at this time. Okay, so to recap of all the examples, and then Colin's going to take over in a second. Okay, so the loan amount, we got a $250,000 loan. The covered payments eligible for forgiveness was $240,000. We know we had a reduction in our headcount of $90,000. Our reduction in pay, we're going to assume 0 when we're comparing apples to apples, the 2 8-week periods. of an 8-week average of the first quarter versus an 8-week average, or the 8-week amount paid. So your loan amount forgiven would be 150,000. So if you take 250 minus 150,000, you're going to owe $100,000 on this loan, and you had the 150,000 forgiven. And then lastly, we're not going to go into this, but of those two reductions, the reduction in employees or the reduction in pay, if you do have reductions when you're doing the calculations, there is a way out of it. If you restore your full-time equivalents or your salary level by June 30th, those reductions won't apply. And it would make it too complicated to go into those as well. So talk to your CPA about that section if you're curious more about how that works. And then the last slide before Colin is, a big question is, are these payments with forgivable funds deductible? Because remember, if you're going to get that $250,000 loan and $150,000 is going to be forgiven, will I still get to deduct the $150,000 on my tax return, even though that loan was forgiven? At this time, we don't know the answer, and we actually hope the guidance comes immediately, because there's a code section that essentially prevents you from double dipping, whereas if you have tax exempt income, you couldn't get a deduction related to it. But we'll have to wait and see how that all works. And then I'm going to turn it over to Colin. He's going to walk through a few scenarios.
All right. Well, thank you, Denver. I appreciate you walking through all those different pieces of this PPP plan. As Denver mentioned, we're going to walk through one company with 3 different scenarios. So we're starting with the maximum loan amount. As mentioned before, we're not going through the detail of how the calculation is performed. But for this example, we have a company with payroll costs, group health insurance costs, retirement benefit costs, and then state local tax compensation. Adding all that all up together, coming up with a monthly average. In this case, the monthly average is $325,000 per month. And then you multiply that times 2.5 months. This company got a loan for $812,500. Let's go to the next slide. This is where we're going to start going through scenarios. So up at the top of the screen, it shows that $325,000 that I just mentioned, which is the eligible items that went into your original loan amount. And then you annualize that to 3.9 million. Divided by 52 gets you $75,000 per week. And then remember, you're dealing with an 8-week measurement period. So you take your 75,000 times 8. So in this case, apples to apples, if this company was able to maintain wages at flat from how the measurement was performed for the proceeds in the loan, this $812,500 loan would only be forgiven by the $600,000 in wages for a flat wage company. So in scenario number 1, we're going to keep payroll costs level at $600,000. We're going to assume the same scenarios under each one of these 3 cases, where you have rent at $140,000 during that 8-week period, utilities $40,000, and interest at $15,000. Now, as Denver mentioned, there are other interests, such as interest on lines of credit, working capital loan interest, and then in industries such as dealerships, dealership floor plan interest. There's not guidance that says those are going to be eligible for forgiveness, so we're not including those items here in this scenario. So in scenario number 1, flat wages, the total amount identified within non-payroll costs, which, as a reminder, they're limited to 25%. Payroll costs are not limited to 75%. So the forgiven portion of the loan that relates to payroll and payroll-related costs can be as much as 100%, and there's not a limit on that side. That's a common area where there are questions and misunderstanding of limits. So for this case, you've got $195,000 in eligible non-payroll. The 24.38 represents the total that would represent as a percentage of total loan forgiveness. And since that's under 25%, all of that is allowable. Right below that, it shows $200,000 as the cap. The cap represents $600,000 divided by 0.75. That gets you the $200,000, which is 25% is the max. So in this case, the tentative loan forgiveness, and I emphasize tentative because we haven't gone through those scenarios that Denver just went over. One of them is your number of employee reduction. Other one is salary reduction. So in this case, you've got $795,000 out of that $812,500 that could be forgiven under this scenario. Scenario number two, this is a company that did have to cut payroll. They tried not to. Of course, if you're working in this plan, your goal and what you're committing to is to not reduce your payroll. But we all know there are cases where you just have to. Maybe you have commission people. There's other examples. We'll get into some of those examples later. But under this scenario, you have $540,000 of payroll costs. Same non-payroll expenses. And as you can see, that percentage has jumped up to 27.08%. What this means is that you would not be allowed to take the $195,000. You would be limited to your cap of $180,000 under the scenario. And your preliminary loan forgiveness, again, is $720,000. You can see that's lower because your payroll costs went down. So regardless of what those reduction penalties, not really penalties, but payroll reduction amounts are, you're still going to be affected by the actual amount, even if you're able to restore headcount or even if you're able to restore the total wages by June 30th that Denver mentioned. We'll go over a third scenario. There are companies that are actually able to hire more people during this time. So we'll go through a scenario of wages increasing from the flat versus the measurement period for the loan of $600,000 up to $685,000. Under this scenario, you have the same expenses and your expenses are back down below 25%. In theory, all that's allowable. And in this case, they are because they're under the limit of $228,333. When you add the $685 in eligible payroll costs plus the $195 allowed, that comes up with a potential forgivable amount of $880,000. Now, this doesn't mean that you're going to be able to get additional money on top of the loan you originally did. At some point, there's going to be a cap. One of the things that's not known is if you do have a payroll or headcount reduction penalty, if you have excess payroll under this scenario, with that excess payroll that is shown here as capped, could that actually be restored? We don't have an answer to it. That's a good question, but at this time, I think the limit is the more conservative way to go. Now, the one other item that Denver pointed out to me earlier today was that there's the possibility that accumulated accrued interest, the less than 1%, if you have an excess here, would be forgiven as well. So that's something to keep in mind. We're not talking big numbers because we're talking less than 1% for that period of the year. All right, let's go to the next slide. All right, this one we're going to have a little bit more fun. We're going to walk through scenario mainly focusing on number of employee reduction. Denver already gave a good example of the compensation reduction, which is that test 2. So we're not going to walk through that yet again. So again, we're starting at the very top at tentative loan forgiveness. Those are the same amounts that were at the bottom of the prior slide. In this case, we have the same answers to the inputs 2 and 3, being that this company had full-time equivalents for February 15th through June 30th of 19 of 85 employees. And then for the 2 months starting 2020, these companies had 90 full-time employees. So the way the calculation works is the penalty is looking to see, based upon the lesser of this 85 and the 90, have you been able to maintain employee count during this 8-week period at equal to or greater than the lesser of these two. As you see, the lesser is 85 people. So in scenario number 1, you have 86 people were retained. As you saw, the compensation remained relatively flat. So we're showing a relatively flat number of employees. Since the 86 is greater than the 85 people for the lower period, which is the period in January and February of 2020, there is no number of employed people reduction penalty. Scenario number 2, as you saw, that payroll went down significantly, went down to $500,000. Well, here you're getting hit yet again on a potential employee reduction hit. In this case, your full-time equivalents during the 8-week period from the date that you received your loan proceeds is 70 people. And so since you had 70 people versus the 85, you're getting a 17.65% potential reduction in your loan forgiveness, which reduces your actual loan forgiveness to a tentative $592,000, leaving an outstanding loan of $219,559. That's assuming that you don't meet the other qualifications that reduce these reductions based upon restoring your employees or restoring your wages by June 30th. In scenario number 3, you have a higher number of employees than your average leading up because you were able to add more. You have 95 versus the 85, which means you have a 0% reduction. And so your full loan under this scenario would be forgiven, and there would be no loan after the fact. All right, let's go to the next slide. All right, we're going to talk just a little bit about compensation because there's a lot of questions that don't have definitive answers. So I'll talk in general about some of the questions that we're hearing and some I would say, I wouldn't call best practices, but best things to keep in mind when you're evaluating your employees. So the first question here is, how do you compensate employees who are in various stages of employment? In various stages of employment, these are just some examples. There's probably more. There's those who must stay home, medical purposes, or they've been asked to stay home by the employer. You have those that have been asked to stay home and are unable to work. And then you have those that are coming into the office of an essential business despite the risk. And one of the common questions is, can I pay them more? And then you have those that are working full-time at home. And you have those that have variable pay plans. That would be commissioned and bonus type people. And how do you handle the expected reduction in compensation due to the slowdown? Other questions are, how do I weigh keeping people paid level versus pay based upon performance? There are companies that are trying to keep people paid regardless of what they're doing. They might not be performing, they might not be trying to perform, or they might be trying as hard as they can, but their situation doesn't allow them to. Can you pay them at that 100% of where they were? You can. Even if they're in a commission structure, you can do that. Certainly, we recommend these areas, you really need to talk with your labor attorney. They're going to keep you in line, help guide you through this so that you're protected. Now, other questions are, can I keep all my people at least 75%, even if they've earned less? And remember, the 75% means that you would not have a reduction in the loan amount. The answer is yes, you can. You can work on keeping their pay at least that baseline level. Now, if they're still doing the full job, can you reduce them to 75%? It doesn't sound like a best practice to me. Now, if you have to adjust people down to 75%, and you're wanting to keep your payroll full as it was before, what do you do with those excess funds? Can you take those funds and reallocate them to people who are having to pick up the slack, or people who are going above and beyond or coming into the office? And I think the answer is you can. You can certainly consider that. In some cases, you have people that can't come into the office that need to perform functions. You're trying to keep paying them at maybe a reduced level. So what you have to do is either shift responsibilities to someone else who can be in the office, or you might have to hire somebody else to fulfill those responsibilities. That's one of those examples of use of those funds. And then how do you maximize the incentivization of your workforce. That's another key question. So in some cases, maybe you end up needing to adjust your pay plans for commissioned salespeople. So for at least a period of time, maybe you increase that commission percentage or increase the bonus calculation, or maybe you increase their hourly rates so that instead of just giving them that money, you're incentivizing them to make the most of the situation and try to still drive sales because they know their commissions for this period of time is going to be higher. And then lastly, how do I keep my number of employees higher with the inevitable reality of people quitting, people being ineffective, or in general, the residual issue of dealing with underperformers? And this can certainly be a challenge. This could be a time for reallocating job positions. Maybe your certain sales are getting harder, and you need to reduce that component of your business and allocate your headcount and your wages over to an area that maybe is showing a higher demand. So you certainly need to go through and consider when you're working through your headcount and trying to get your headcount back up to maximize forgiveness by June 30th, you can reallocate. It doesn't have to be the same people that you rehire. Again, talk to your labor attorney. They'll keep you in line. All right. I'm going to finish up with best practices. And just so that you all know, we are going to have some additional discussions that Denver's going to finish up, and then we're going to go over the common questions after this. So in best practices, we're talking mainly on now that you've gotten your funds, or now that you're going to be getting your funds, what do you do? So question number one, the main easy answer on that is, for an example, where you receive $500,000, you would be debiting your cash and crediting a notes payable. This is not income when you receive it, so you should not be reflecting that in your financial statements as income. So a component of that might be a long-term debt, so you need to consider that when you're doing your analysis and your charting and your financials. Secondly, how do you isolate those funds? Because as Denver mentioned, you should not be using those funds for repayment of debt, other expenses. So what do? A best practice, which I know many of you don't really want to do, is if you can open up a separate bank account, or if you happen to have one that's not being used, you park those funds in that account. You only relieve those funds when you have eligible expenses that you know are going to be part of the forgiveness. This will allow you to ensure that the funds that are not being used for eligible forgiveness items are still there and have not been commingled in regular use. So other companies have interest-bearing accounts. You can park them in an interest-bearing account. And then many of the clients I've talked to just don't want to do either one of them, and they'll put it in their regular operating funds. This just means you really, really need to work hard at ensuring that you're tracking those funds so that those funds are still in your account at the end of this period. And I'm not sure exactly how you'd want to measure it. Maybe you start out by saying, my cash balance, the date that I received the funds, was $700,000. So it was $200,000 before the funds came in. Make sure that you're maintaining at least that $200,000 and not less, or that $700,000 for that period, unless you're using them for eligible funds. So it does make it harder if you don't do it that way. The third one is, how should I account for eligible expenses as the expenses are paid? So this would be your payroll, your rent, your utilities, your mortgage interest. We recommend that you, and look, everybody has their own opinions on this, so don't treat mine as a gospel. But if you treat these expenses as you normally would, you're really going to be able to determine how are you performing and how is your company measuring in their performance during this period. If you don't recognize those expenses and treat them as a prepaid expense that you're going to offset later, you really, really don't know how you're doing. So the last item on this piece would be, you really need to focus on record keeping. Do that record keeping now. Before you start, anytime you have what you consider to be eligible payroll, remember, capped at $100,000 annually, document. Create a log. Anytime you have invoices that come in, you're going to pay them, just put that invoice in your file. Put your payroll in a file. Create a log as you go. Put all the information in there as you go. Put your lease agreement in there for any rent that you're paying. Have it ready so when it's time to get in line for getting your loan forgiven, you're ready to go and you're not scrambling then. So last item here is, what do I do with the liability on my books? So in a scenario where you have a $500,000 loan, of which $400,000 is forgiven, what do you do with that $400,000 at the end of the day? And there are definitely different answers to work through it. One common plan that I've heard in talking with clients is you take the $400,000 to other income in the month of forgiveness. You can certainly do that. You can also wait and you can hold and you can take that in your December financials or on your tax return. There's many different ways that you go. The key is to make sure that when you take those funds into income, that you consider, are there pay plans and bonus or commission structures that would be positively affected by taking that supplemental money in one way versus another. All right, I'll hand it back over to Denver.
Sure, thanks, Colin. I think you hit the nail on the head about the documentation. Just be aware that the lender is going to be the one that's going to approve the eligible expenses that you are claiming to get forgiveness. So think about like the head count. They're going to want, excuse me, you're going to have to be able to verify those numbers. You're going to probably have to give the payroll tax filing forms that were filed, canceled checks, receipts, and whatnot. Exactly what Colin talked about. And then let's go to the next slide. Okay, one other item that is semi-related. There's a payroll tax deferral that from March 27th, the IRS allowed you to defer the employer share of Social Security. And how it would work is if you had a pay period that came up, you could defer that the employer side of Social Security. The first 50% would not be due until the end of 2021, and the second would be due on 2022. And in the act, when it came out, it stated that if you receive a PPP loan, you cannot defer the employer side of Social Security. Well, the IRS came out, I think it was on Friday of last week, and they stated that people that do receive a PPP loan can defer the employer side of Social Security up until the date that they receive confirmation of what the forgiveness amount will be from their lender. And then going forward, they can no longer defer any subsequent Social Security, the employer side of Social Security, but the part that was being deferred up until that date will continue to be deferred. So this is just another way that you can basically get a interest-free loan from the government. And then we're going to go to commonly asked questions, and Patrick's going to take over with the questions.
All right, thank you guys. One of the first ones I think we're going to touch base is when calculating payroll costs, do we use gross salaries, wages, and commissions, or is this net of taxes and other deductions? And can I include the employer portion of the taxes? I'll ask that to you, Colin.
Yeah.
Oh, go ahead, Denver.
Oh, yeah, sorry. So how it works is you're going to use the gross, and gross includes the employee share of Social Security, Medicare, and also there's confusion over if I had to subtract out the employee's share of federal income tax withholding. The IRS, or I'm sorry, Treasury came out and clarified that in a FAQ that stated you use the gross amount. And to the second question, can I include the employer's portion of taxes? No, you cannot. That's considered payroll costs and that'd be separately stated on your financials. You do not get to include the employer's portion of Social Security or Medicare in payroll costs.
All right, thank you. How about for people I pay more than $100,000 annualized during that 8-week period? Are they fully excluded from the forgiveness calculation?
We touched on that earlier, but they are certainly not excluded. What happens is they are just capped at $100,000.
Yeah, and to add more on that, because payroll costs is the same definitions used for the loan amount and then also for the forgiveness calculation. Remember, for the forgiveness calculation, you're only going to be incurring expenses for an 8-week period. So you'd have to figure out what the annualization of $100,000 would be over that 8-week period. And based on a recent guidance that the SBA released on Tuesday, they are taking 8 weeks divided by 52 weeks times 100,000. That comes out to $15,385. So it looks like if you went and paid someone, whoops, let me clear this out, sorry. It looks like if you, let's say you paid someone $50,000 in the 8-week period, I believe you're only going to get to count up to, I think the annualized portion of that would be the first $15,385. The remaining amount you would not be able to count it as an eligible expense towards forgiveness, only the portion up to the cap.
Thank you. So what happens if someone is employed in Q1, but they are fired before that 8-week period begins? Are they included in our forgiveness reduction calculation related to the reduction in pay?
Okay, so that's a great question, and a lot of people have asked this. We don't know, to be honest. But it seems like because the definition of, it talks about employees, look to employees' pay over the covered period. Well, if someone was fired before, because the covered period's the 8-week period, if someone was fired before the covered period started, which would be when the 8-week period started, it would seem like you wouldn't have to include them when you're looking to see if what employees had wage reductions of more than 25%. Because what this question's really getting at is, let's say I paid someone in Q1, and then I'm comparing all my employees, what they earned in the 8-week period to Q1 to see if they had a 25% reduction. What people are thinking, well, if I fired that person before the 8-week period started, they're going to have no wages paid in the 8-week period. So am I going to get dinged for that full amount of what they got paid in the first quarter versus what they didn't get paid in the 8-week period? And I don't think so, but we need more guidance from the SBA to know the answer on that one.
Well, and remember, there's also the number of employee and wage measurement as far as the add back goes. And so if you did fire an employee, but then you rehired somebody else to take their place, then you've replaced the number of employees, and you've also potentially replaced the wages as well. So you might be hit with a negative if that's how it ultimately lands, but then you have the chance for clawing that back.
Yeah, and the part, just to add on, the part that Colin talked about clawing it back, there is, we didn't go into it, there's essentially like a restoration exception. If you hire or restore people's salary by June 30th, you can get out of either the headcount reduction or the employee pay reduction, which is the 25%. But that it's just very complicated, and we didn't go into it in this presentation.
Colin, I'm going to give this one to you. To remedy decreases in payroll, can I provide a bonus to new or existing employees?
Yeah, so you certainly can bonus employees. Just remember that if you bonus and you kick them over the annualized $100,000, it's not going to do you any good for the amount that's over that $100,000 in that period. Now, if you hired a new employee during that 8-week period and you bonus them in that hire, We're waiting for guidance on this, but there's a good chance that that bonus would need to be annualized for that period. So if you hired somebody towards the very end and bonus them, you might in fact cap them. So yes, you can bonus. In many cases, you can bonus to help remedy shortfalls that they would have otherwise.
And to kind of stay with the same payroll questions, we had a couple that came through the Q&A that I thought were pretty good that maybe you guys could help us answer here. One of them was talking about the timing of the payments. A lot of times we have, a payroll that runs from, maybe April 1st through April 15th and then paid out on the 19th. If they receive their funds, say April 16th, and they pay for a period that was before the funds were received, but paid on April 19th, can they use those funds towards their calculation for forgiveness?
Denver did mention in the presentation that most of these costs, if not all of these costs, are going to be on a cash basis. So in that case, it sounds like as long as that's how historically the company has paid their payroll and there's not manipulation and pushing the payroll out so that it falls into that covered period, we think it would be includable in the 8-week period. So we wouldn't recommend that you start deviating from your norm, because when it comes to the loan forgiveness, there's going to be significant scrutiny in that process. And so we don't know how in depth they'll go into it, but let's just say that historically you pay on the 15th, wages on the 15th, and you chose to push that out so it was eligible. They can identify that as a deviation and potentially that and maybe other ways you attempt to manipulate. They might disallow those expenses. So you just have to be conservative in how you do it, and if you choose to be a little bit more aggressive, just be prepared for disallowance once that audit process is completed.
Yeah, we also got a couple other questions about changing the current payroll if you have people that are semi-monthly, maybe going to a weekly. And I think that kind of falls into that answer that you gave as well, to kind of just, and you could reiterate that again, but we don't know for sure, but any deviation from the normal might be questioned further, right?
Yeah, I would say that if you have questions on areas that are either not addressed or they're fall into a gray, talk to your labor attorney. They might tell you the same thing. We don't know, but I would certainly look to get guidance from the professionals that are addressing the law component, which is where I think this falls.
Okay, Denver, the next one's for you. If my rent or mortgage is deferred by the landlord or bank, are these expenses forgivable when paid?
Based on my understanding is that it's going to be, until further guidance that comes out, it's going to be on a cash basis. And if they're not paid within that 8-week period, I don't think you'll be able to include them as an eligible expense, because it says incurred and payments made. So
what is your thought on if a landlord had some abatements where they maybe decrease the rent for those next couple months by half? Would that, even though it doesn't necessarily match up with their actual lease terms, they would still be able to use that rent probably, correct?
oh, that's a tough one. I mean,
Sorry.
Usually we
think-
get the other one, which is, can we bump up the rent?
yeah, I think you would be, I mean, I'd assume you'd be able to count that because you are incurring the expense. It's only a portion of it's being deferred. I wouldn't see why not, but
I would agree. And then going into the other piece, if you have a lease in place, you can't go in and bump your rent up because it's with a related party just for the sake of incurring more costs to get more forgiven.
yeah. And to add on to what about like not playing around with things, but just doing certain things. A lot of people have been asking, can we go and set up a 401k because a lot of people are looking at this and seeing when they got the loan amount is based on usually 2019 payroll costs, but for a lot of companies right now, the payroll has gone down, so they're thinking of ways to get the payroll costs up so they can get it forgiven. We don't know the answer yet if you go and start setting up plans so that you can make 401k contributions employer side. We just don't know the answer to that yet. Those are good ideas to increase your payroll costs, it seems, but we'll need more guidance to know if that will actually work. There's nothing that says you can't do it right now, but I'd be hesitant to advise someone to go and do a bunch of do that and bank on that they're going to get that forgiven.
And then in that same line, can my rent be considered for this forgiveness calculation if it's between a related party?
Yes, absolutely. I think Denver covered that earlier too, but to reiterate, as long as there's a lease in place and as long as it was in place before February 15th. Now, if the lease expired and it just operated on a month-to-month basis and there's not an active lease with that related party or with a third party, I think the answer is it's not a deductible item because there was not a lease in force.
And finally, one last one for you, Colin. This is for you. Why are we recommending that these companies set up a separate bank account for these funds and calculate them that way? Can you kind of emphasize that a little bit?
Sure. I think I touched on it a little bit, but it's more of a best practice. As we said, what we don't know is if there is a loan amount at the end, what is the SBA going to be looking for? Or more importantly, the people who are evaluating these forgiveness applications for the SBA, what are they going to be looking for? So the more that you, in my opinion, A, have it documented, B, have it segregated, just if you focus on those two pieces, you're going to be in a lot better position to be able to mitigate any of those unknowns that we don't know right now, and don't want to advise it the wrong way for. Does that answer your question, Patrick? Sorry, Denver, go ahead.
Oh, no. I was going to mention one other thing after this. I thought they were going to cut it off. Sorry.
Okay.
No, I think that answers our questions.
Okay.
Just one last thing, because I saw someone ask the question, what is the best source to hear about new interpretations besides these webinars? If you go to the Department of Treasury's website, on that on the first page, when you get to their homepage, you'll see it's like a COVID-19 and it's all in red midway up their page that you can click on. Once you click on that, it'll give you most recent stuff they're adding, all the interpretations that they've released. There's an FAQ in there that they're updating on a daily basis, and there's new answers to questions that people are constantly asking. So if you want more resources, you can go to their page and find information.
Let me chime in here on this last slide that we're showing here. As we mentioned, we're not going to be focusing as much on the answering the questions in the Q&A, and there are a lot of them. If you have questions, we can try to answer some of them. If you'd like to send those to us, send it to askus@lgt-cpa.com, which you can see on your screen. And we hope you found this webinar to be very educational and answered many of your questions. As Katie mentioned before, we are making this the PowerPoint available to everybody, and we really appreciate you all spending your Thursday afternoon with us. Had to think, with us all working remotely and all, what is today? But yes, it is Thursday. But thanks everybody for joining us, and we will look to have more webinars out for everybody in future periods as well. So thank you. Y'all have a good evening.
Thank you for joining us. As more guidance comes down from our government and the IRS, We pass that information along to you on our COVID-19 financial updates page. The link is in the description below, along with other important links, including our social media. If you want to see more of the past Lane Gorman Trubit COVID-19 financial webinar series, please subscribe and hit the bell icon for notifications.